Ring. I'm the Senior Marketing Manager at Mortgage Capital Trading. We're excited to present this video in partnership with Freddie Mac. This will be the second video in a two-part series. The first video discussed leveraging options in a volatile market and ensuring your execution strategy includes servicing considerations. This video will focus on benefits of Freddie Mac approval and MSR retention strategy, as well as a review of how cash flow and capital position may affect your retain release decisions. I'm excited to announce today our moderator, Mr. Bill Shirreffs. He's MCT's head of MSR services and sales operations. Bill, take it away.
Thank you, David. Really appreciate it. I think, like I said the last time, what we'll be discussing today will certainly resonate for folks with rising interest rates, overall declining mortgage production, price competition, pressure on margins. The servicing asset is an even more critical element today, an essential component of the overall best execution equation. Before we actually jump in, I want to reiterate that we greatly appreciate our partnership with Freddie Mac, our long-standing partnership. MCT and Freddie Mac continue to work collaboratively to drive efficiencies for the industry and our mutual clients, and those efforts are ongoing. Thank you for all that you do to ensure mortgage liquidity and sustainable home ownership. We appreciate you being with us today, Hakan, and your participation in this webinar. Like David said, I'm the head of MSR services, Bill Shirreffs for sales operations. Let me just take a minute to introduce the folks on the line. Three industry experts, starting off with David Burruss. David's our MSR services sales director. We've got Azad Rafat. Azad is our senior director of MSR services. And like I said, Hakan Beygo. Hakan is the senior director of bulk loan acquisitions and servicing release execution for Freddie Mac. Again, we appreciate you all joining us. And what we're going to be getting in today, a couple of really key topics. Number one, the benefits of Freddie Mac approval, having an MSR retention strategy, and then secondly, how cash flow and the capital position may affect your retain versus release decisioning. So with that, let me turn it over to Hakan.
Thanks, Bill. So we're going to lead off with benefits. Why should you become, or why should you apply to be a seller servicer with Freddie Mac? And talked about a little bit on a prior video about the optionality and the ability to give yourself optionality. And that's critical in markets that are volatile, which we're seeing now, and we've seen really for the past 2 or 3 years. And one of the ways to do that is to have both options to sell servicing, options to retain servicing. And the benefit of being able to retain is, when you don't like where the market is, not only from a volatility standpoint, but even just from a pricing standpoint, or for any other reason, if you want to be able to retain that borrower, retain that MSR, then you need to have the ability to do that. And what you need to do is you need to get approved for that. That process should start now. The process of getting approved can take some time, and starting that early and getting that approval process started early is one of the things I would highly encourage everyone to do. Again, to give yourself the option to retain if the market or your firm's situation dictates that you should retain. But when talking about retaining servicing, there are a couple things to consider. The cost, right? You need to have infrastructure in place, or you need to be able to purchase infrastructure to put in place in order to service properly. If you don't have some of that available, but you have the financial wherewithal to retain the MSR, you may want to engage a sub-servicer and just pay a fee to the sub-servicer to do a lot of that servicing for you. Either way, those are things you need to look at. You need to look at whether to do it yourself, whether to have a sub-servicer do it, the costs involved in that in terms of technology, in terms of people, in terms of infrastructure, and also get the approval process started so that when you need it, it's available to you and you have more optionality depending on market conditions.
That's a great summary, Hakan. Thank you for that. We often talk about the pandemic because the pandemic really forced a shift in the market almost overnight. Multiples went to zero, and we've talked about this quite a bit, Hakan, where the market in some cases was less than zero, and the exchange program had a multiple. It wasn't, aggressive or healthy, but it was more than zero. So the clients that are on that platform at least were able to benefit from that execution. So that just is one example of how options can certainly help you in times of volatility and can make a significant difference. But beyond the execution, there are other considerations as well that servicers need to think through when they're deciding what sort of strategy they want to pursue relative to servicing. Azad, maybe you can talk a little bit about the non-execution elements that are important.
Yes, thank you, Bill. One of the things when we discuss servicing retention with our clients, for now, at the time being, majority of the clients that we spoke to who started retaining right after the pandemic, the majority of them stated the fact that they like the servicing for different reasons. But the most common answer that we got is that the fact that it generates cash flow for them in times such as now, that they're experiencing the origination side is slowed down. So the servicing portion of the business is compensating for that loss in revenue from the origination side. So that fact remains so, and also depends on the size of the portfolio. Obviously, the larger the servicing portfolio, the more benefit you get from it, and also helps you keep the business afloat. Unfortunately, the ones that don't have servicing, right now they're experiencing some financial difficulties, trying to figure out ways to save money by letting people go or finding other ways to make up for that loss. In terms of servicing asset is a cash intensive asset. That's something we always remind people about that. It takes cash to manage the business, but if you have a decent size portfolio, it will help you with that. The nice thing about having a servicing asset, it bolsters the enterprise value. It increases the value of the business. You have a larger balance sheet, and with that larger balance sheet, it helps you also it gives you some additional financing option. And instead of relying entirely on warehouse line of credit, you could use your MSR asset to finance that business. So there are so many ways having a servicing portfolio will benefit the business. And also in times of need, like right now, probably a lot of originators are letting their underwriter go or their processors go. But in times such as we are experiencing right now, you can shift those value people to your servicing division and help the business stay in the business, and help the employees stay in the business and expand their experience as well. And as the business goes back to origination, those employees that you kept will help you with that side of the business, and you don't have to start looking for additional employees and pay for that cost as well.
To your point, Azad, there is an impact on cash flow, right? And that's a consideration that is some companies don't have the wherewithal to retain servicing. They don't have appropriate capital infrastructure, all of that to retain servicing. So David Burruss, maybe you can talk a little bit about cash flows and the impact on retain versus release decisioning.
Sure. We one of the it's kind of interesting. One of the unintended consequences were that many people ended up with a portfolio 4 or 5 times larger than they ever anticipated, just to maintain and try to make the most of the value of each loan that they held. And with that, fell upon them very quickly a larger responsibility than I think they had ever intended or ever come across. And certainly, while one of the benefits is the cash flow side, the other side is just managing the risk about having a portfolio, managing its values, how to record those, how to take advantage of those. So those are all big pieces in terms of working with that. And then, of course, as I was pointing out, one of the cash flow is always the issue about if you can support the portfolio or not. Can you put more of your production into the portfolio, or does the cash requirements of your company require you to continue to really just go released. What we've noticed is a number of our people have really started to target trying to build a portfolio large enough to pay off 80–90% of their expenses on a monthly basis. And based on doing that, it gives them freedom to really approach the market in a more aggressive way in a number of different areas, knowing that their basic costs are kind of covered by their portfolio. Obviously, they have to pay attention to their management in order to do that, but it's a freeing kind of experience in that regard. Others, this whole experience for them has been more challenging than they care to really talk about. So many of them have really considered, particularly in this marketplace where this year has really been challenging from a production standpoint, margin compression has been huge. They've really looked at the idea of should they sell their portfolio and generate a kind of a cash return there to really help them with their expenses and their model through the course of the year. So we've seen those several kind of strategies be active and in place kind of as we go forward. So I don't know, Azad, do you have anything else that you'd like to add to that?
Yes. One of the things that we deal with on a daily basis, just like you said, David, is really managing that cash flow. How you're going to go about managing the cash flow and then manage the business down the road. Obviously, the balance sheet that you carry with the servicing asset depends on the current market where rates are, will impact how that balance sheet gets inflated or deflated. And then at the same time, the revenue stream that you're getting from that servicing. Obviously, the larger servicing portfolio you have, the more revenue you have. The key is the value of the business. The larger the servicing portfolio you carry, the more value the business is worth. And we've seen, and we've been discussing as of late with some companies how they're gonna perform down in the second half of this year and what they're gonna do, what their strategies are. Some of the companies that have about $1 billion or more are feeling more comfortable with the asset level that they have, and they feel like they're not going to need to do anything drastic. And they're even selling almost 100% of their new origination servicing release because they're staying afloat with the servicing asset that they currently have. On the other side, we have companies that we spoke to. If they have like close to 2 billion or 3 billion, or even a smaller portfolio, less than $1 billion, they're feeling they want to take advantage of the current market and generate that additional cash to help them sustain the business, or even invest in other opportunities, invest in technology, invest in other ventures that help them grow the enterprise that they have.
What's interesting about servicing, and maybe you can elaborate on this a little bit more, Azad, is that you have flexibility around your strategy. You can retain some, you can release some, you can retain it all if you'd like, you can release it all if you like. You can bulk, you can sell on a bulk basis at a point where you need the cash, or you could also finance. So maybe you could talk a little bit about MSR financing, Azad, and I think that's something that we expect to increase in interest in the coming months.
And actually, it already has. We're seeing more and more companies that own MSR started to utilize the MSR asset and start financing it. They're getting really good rates on those. They're pretty low. They range anywhere between 3%. We've seen as high as, a little bit closer in the high fives. So, but in terms of the rate they're getting to finance the MSR asset is very beneficial for them. So what's taking place right now, the flexibility the servicers have right now, really it expanded beyond just originating. Right now, we're seeing folks where they retain as little as 20% from their originations, because of the volatility in interest rate. But then we have others decided, they don't want to deal with the volatility and they're going to release 100% of that origination. But then at the same time, we have others, they like to manage their risk and keep their clients, with their company. So they retain somewhere between 40 to 60%. And all depends on the strategy the business undertakes. What is the strategy, the ultimate strategy? Is it financial? Is it relationship? Or a mix of the two? Some companies would like to have a mix of the two. That's why you see 40, 60% combination, depending on where rates are, they may release 40%, retain 60, or the opposite. But then others look at it from pure financial and volatility, and they say, well, I don't want to deal with the current market right now. I don't want to take and carry the risk of loans, at 5.5 interest rate. So they decided they're gonna release everything and wait and see attitude. The others, they want to kind of continue with their business as usual that they've been pursuing over the last year and a half or so, retain about 20, 30% and sell the rest to the buyer that pay them the most. So those are the strategies that you could approach, but then all depends on the business. What is the business foresees in their origination, and what is the ultimate end goal from the servicing business? Are they we want to grow it steadily and slowly, or steadily and aggressively, and then sell pieces of it down the road? We've seen few companies utilize this approach. They take about 40, 60% retention, and then every 6 months they would sell a piece of it and make up, with the MSR value. Right now, maybe it's a little bit different. I spoke to one particular company. They had this strategy in place over the last 2 years, but now they decided they're not going to sell anything, on bulk or kosher. They're going to retain as much as possible, but they're going to hold on to it for, when rates improve, when the environment, market conditions improve, and then we'll probably sell some.
Yeah, and that's really the key point there, Azad. Like Freddie Mac, MCT engages with mortgage originators of all shapes and sizes, including independent mortgage bankers, banks, credit unions. We see it all. And every situation is different based on their own corporate objectives, their own direction, their own capital position. Every situation is different. And we can certainly leverage our expertise and exposure to the market to assist originators and clients with helping them, make certain that their strategy is informed based on peer analysis, based on, what we're seeing in the market. And I know that Freddie Mac has a similar perspective, Hakan.
Yes, we do.
Yeah. So thinking about, the pros and cons, it's got to be in line with, like we just said, with the strategic direction of the company. And I think, MCT is uniquely positioned. We've got the expertise and, the resources, not only on the pipeline hedging side and the best X side as well, but also MSR expertise. We cover sort of a broad range of disciplines. And we understand the importance of ensuring that a company's strategic alignment is sort of across the board. And it's risky to have secondary marketing have one strategy and then the servicing group have a separate strategy. They've got to be aligned, and they should be developed, together and not in isolation. So that's another element that we would encourage our clients and listeners to make certain as you're building out your company strategy that it does include not only the hedging strategy, the best X strategy, but also servicing as well. Any additional thoughts on that, Hakan?
I agree with you, and I think you're touching again on the need for a more holistic view, but also the need to incorporate all costs, things that we've talked about in this video and prior videos, and having options available to you and all the options available to you. Again, we have seen disadvantaged entities because they couldn't do one or the other, right? They either couldn't sell the servicing or they couldn't retain the servicing. And they didn't have optionality, and they didn't have the ability to respond and react and make the best that they can of difficult markets. And again, what we see is typically that there's never, I don't know that there's ever an easy market unless there's like, you know, one of the massive refi booms that we've seen. And when you don't have that, right, then you've got to be able to do, and you've got to be able to react. And the only way you can do that is if you have all your options available. And what I mean by that is the ability to retain or release, but in addition to that, the ability to choose how you release and to have multiple liquidity options available to you in multiple programs. You know, that's, I mean, I can't emphasize that enough, actually, that it's a key that you need to have. And, you know, Bill, I think you touched on a little bit is also looking at everything, not only strategically making sure your different areas are aligned on the strategic approach, but also making sure that you're looking at all the costs that are involved in whatever option that you take. And those costs are sometimes not terribly obvious, especially if you're in capital markets and you don't have a lot of discussion necessarily with the folks that are on the ops side and what that means to them, the decisions you make. But in environments like this, where managing P&L and it becomes such a critical part of, in some cases, survival, but really just optimizing the environment, those types of things need to be looked at if they're not being looked at right now.
Yeah, probably more now than in a long time, right? Given where the market is with tight margins. When margins were healthy, people could get away with not getting incredibly strategic about the servicing part of the sale of the asset. Now it's critical. Margins are narrow, production's down, competition is tough right now. So all of the elements that need to be considered in the execution analysis, and that includes servicing, not just the cash flow impact, but also the operational impact as well, to your point, Hakan. And then secondly, the options, right? And without options, we saw a lot of folks after the pandemic get caught flat-footed, where they really had to sell to the aggregators at a zero multiple, and in some cases less than zero. The ones that at least had the flexibility to retain are the ones that were healthy after the pandemic. So having those options to pivot when the market dictates are critical. And then just building on a point that Azad made earlier around balance sheet benefits, you know, increasing the value of the enterprise. Servicing will do that. And having that asset, to me, it creates more stability for the company. You also have the ability to liquidate that asset when appropriate. And that's something that can material offset decline in production revenues if that ends up occurring, and it is occurring now. So the companies that are holding servicing have more options. They have more options around whether they want to finance that asset, whether they want to sell all or a portion of that asset. Whereas the folks that didn't retain servicing at all, they're relying on their pipeline hedge. You know, that's really their only offset today. Whereas the servicers have the cross sell, the cross hedge from the cash flow off the servicing portfolio. And I think we have one final key takeaway. Hakan, I'll let you bring us home.
Reach out. You know, there's going to be information at the end of the video about how to contact us in Freddie Mac and MCT, but in terms of becoming a servicer, right, and going through the process of asking to be a seller servicer, and we'll have information on that. But all the stuff that we've thrown at you, you know, if these are new or these are things you're not thinking of, then you've got the resources of MCT to help you with this, to help you understand balance sheet, to help you make decisions, to help you through the process of building relationships, liquidity, and having the ability to have these options. And you've also got, you know, Freddie Mac to talk about the different programs that we have and what type of programs are available to you if you want to sell. What I would say is, in addition to the information that's kind of at the end of the video in terms of places to go, I would say, speaking for all of us, any one of us, you know, you can reach out to any one of us to ask about any of the things that we've discussed. on this series of videos, and we'd be more than happy to help you or point you in the right direction and kind of get you the right guidance you need in order to make these decisions.
Let me just take a quick minute just to cover the 4 key points before we say goodbye. Number 1, leveraging options in a volatile market, having the flexibility to pivot when necessary. Ensuring your execution strategy includes servicing considerations, not just looking at the whole loan. Number 3, benefits of a Freddie Mac approval and having the flexibility to retain if you choose to. And then lastly, how cash flow and the capital position may affect your retain release decisions. Those are really the 4 key takeaways and what we've covered over the last couple of sessions. And let me thank all of you. Hakan, thank you very much to you and the entire Freddie Mac team. We appreciate the partnership. David, and Azad, thank you guys for your participation. It's been great. Really appreciate it.
Thank you so much.
Thanks everyone. And thanks, Bill, for moderating today's discussion. And thank you, David, Azad, and Hakan for joining in on the conversation. Again, if you'd like to touch base with anybody on this video or learn more about Freddie Mac or MCT, we will include that information in the description of these videos. Again, just special thank you to Freddie Mac and Hakan for being here today, and look forward to our continued partnership. Thanks, everyone.
Absolutely.
Thank you.
Thank you.